Let's welcome our market master, Manish Sonthalia, Head Equities PMS at Motilal Oswal Asset Management Company, joins us now. Thank you very much for joining us, Manish. Good morning to you. How do you tackle this? Are you going to look through this pandemic, believe that, in 3-4 months, the vaccine shortages will be over and we may have more vaccines than we need? So you're buying the distress now at all?
So, Lata, the case to fatality ratio is still around 1%, or slightly below that. So, I think vaccination is working. Of course, the shortfall in vaccines will have to be made good. That will happen over the next 2, 3, 4 months. So, I would believe it's a buy on dips market. You could have a percentage or two of shave off of the real GDP projected for this year. So, if earlier it was 12.5% or 12%, this time around, it should be around 11%. So, I would believe that the economy recovery is here to stay, and these shortages, etc., on the vaccines front will be made good in some point in time. And the case to fatality ratio is still on the lower side. So, we can't really say that the situation is similar to what we saw in the first lockdown. On that front, I think I remain optimistic on the markets going forward, look to buy only.
Okay, fair enough, Manish. Good morning. Though some will argue that at a human level, the situation now is much worse than the first wave. But I take your point. And because you're keeping the faith in this, let me ask you about the lenders in the financial stocks. Beyond an ICICI or an HDFC, beyond the big private sector names, in the tier 2, would you use this dip to buy anything? A Shriram or a Canfin, maybe even some of the smaller lenders?
No, I think, I'll give a pass to the smaller lenders in total. If at all there is a cyclical recovery that's going to happen, and that's going to happen, it's going to benefit the larger entities, both on the NBFCs and the banking space, disproportionately as compared to the smaller lenders. Because the MSME space still remains quite stressed, and the mid-cap banks or mid-cap NBFCs would have to face the brunt on that aspect going forward. And we're really not sure, how much of a provisioning further would be required in the course of the second lockdown. Slippages in any case are on the move after the moratorium has been done away with, vis-a-vis the pro forma numbers. So I would stick with the larger banks, and on an overall basis would remain underweight on banks.
Okay. Manish, I want to come to a sector that Motilal Oswal in general and you in particular have followed very closely, auto sector. We've just got the Bajaj Auto numbers, and 3.88 is way better than what the street was expecting. Overall sales 3.88 lakh for April. The domestic sales are not much to write home about. It's 1.34 lakh. That's a disappointment, but the exports have come in full blast at 2.53 lakh. Do you think this stock merits a look-in simply because it's diversified?
No, it does merit a look-in, and not only this name, but TVS Motors, etc.
Yes.
They were spectacular numbers, so to speak. Much better than what at least I would have expected. And sustainable double-digit margins are coming through even for the second time. The previous quarter they clocked around 10%. Now it is beyond 10%. So I think in these times, guys who are able to actually contain costs and mitigate the shortages on anti-lock braking systems, or who are well prepared on that front, it's a matter of time when personal mobility would be preferred in the course of the first lockdown or the second lockdown or the third lockdown. There will be a third phase also sometime in the future. So on that front, I would again look at the auto space as a cyclical recovery play, and on that front, would look to buy automobiles. If there is correction, and we are seeing some correction, so I would not hesitate to not buy into the auto space as a whole. And Bajaj Auto numbers, whatever volumes they have clocked, is very, very good.
Yeah, absolutely. Their exports are firing on all cylinders, it would seem. What about steel and metals in general, Manish? There's been this one-way mega rally. Price hikes are still coming through. But the question is, can one still buy the stocks, or is it a little too hot now?
No, given the news flows around the steel sector, I think steel is now poised for a bull run for the next decade. It could play out that way. And, third price increase. I mean, today only we came to understand that export prices are higher by 4,500 rupees per ton for the month of May. And that is roughly around, $60 extra. And still the domestic prices are below the international prices. I mean, there will come a point in time when the export prices will be at parity to domestic prices. And export prices, because of the strong demand for steel, I mean, $2 trillion worth of additional infrastructure, projected out of the US, and similar numbers coming out through various parts of the world. And even in India, if we are projecting a private capex recovery, for steel would be the thing that would be required. Steel production month on month is increasing globally. So good times are here to stay for the steel sector as a whole.
Okay. Manish, in February and maybe to some extent even in early March, just everyone who came on the channel was saying that now we should be entirely on economy-facing stocks. Clearly, that set has got a jolt after this unexpectedly ferocious second wave. Now, how will you construct your portfolio? Will you be equal weight on global-facing and domestic-facing? What would your mantra be?
I mean, the overweight sectors would be consumer staples, discretionary, IT, and pharma. And the rest of the sectors would be either equal weight or slightly underweight. But that's not to say that economy-facing stocks don't warrant a relook from that point of view, industrial, because I clearly believe that cyclical stocks will start to do well maybe from the second half of this year. And from that point of view, it does make sense to have a foothold into those sectors, even if it is not equal weight, stands at underweight position, but one must have a position in that space. But the favored sectors, so to speak, would be the likes of IT, pharma, consumer, both staples and discretion. I would remain underweight on that. That's a economy recovery play, but there's a lot of uncertainty, and because that's the most leveraged space, and leverage does harm in times of uncertainty. And so from that point of view, lenders specifically, I would be very selective in having those names which would get less impacted if this was to get prolonged over a longer period of time.
Okay, by the way, just want to point out that there is a recovery underway as well, and the Nifty's cut its losses by half. Now we're down just about 100 points, and you've got names like IndusInd Bank, Kotak Mahindra Bank. They're racing back to the top side of the screen now. Bajaj, of course, we've discussed Bajaj Auto, as well as some of the steel stocks that are doing pretty well. But the banks are trying to sort of cut back their losses as well, and IndusInd in particular is doing really well. Manish, what's the sense from here on for the market? Is perhaps consolidation with a slight upside bias the best case? Or do you still see triggers? I mean, when we entered the year and immediately after the budget, there were all of these earnings upgrades coming in and expectations of a very solid recovery. Has that gotten pushed back? And if yes, by how many months and quarters?
Whatever numbers have come through, on the index front, the IT, the bank names, selectively some of the consumer names, there would be a slight cut in FY22 EPS than when we began this quarter, the fourth quarter numbers, and now in the middle of a pandemic. So I think there will be some earnings, which will take a hit on the index per se. But I clearly believe that market will look through this correction as it has always been in the near term, near past. As soon as you see some dip in the daily numbers of cases, you would see the market start to move higher. So from that front, I think people are looking to deploy capital. They're just waiting on the sidelines. There is enough appetite, and the belief is that the earnings recovery will be far sharper going into the next 2, 3, 4 years. But one has to see through the volatility, and that's how I think the markets are looking.
Okay. Fair point, Manish. Thank you very much indeed for joining us. We have to see through a troubled couple of quarters, and thereafter, of course, you can look at earnings. Thank you very much indeed for joining us with your thoughts. We are looking at a series of earnings that